It's showtime. All right. People streaming in right on time. Just waiting on Monty to hop up. We'll give people a few minutes to shuffle in. Expecting a good crowd here today, as I vamp as the only one on screen. Gonna open up the chat here. Well, here's Monty. Here's Monty. I was about to ask everybody to let us know where they're viewing from. I always feel like, especially with tax stuff, it's always helpful to have a mental map of the geographic scope of these type of things.
Yeah. Let us know in the comments of where you're joining us from. Appreciate everyone joining, and as Jeff mentioned, we'll get started in the next probably 2 minutes.
Couple of minutes. I was talking off screen with the team about what sorts of Los Angeles, here we go. Hey Narav, how's it going? I see your name there. Michael Beller in San Francisco. Austin, good representation of our base of clients there. I feel like every call I end up just saying that someone's calling from a place where we talk to a lot of folks, because both because we talk to a lot of folks and because it tends to be people from Becca's neck of the woods in Austin, LA, San Francisco.
Yeah.
And then I'm sure we'll see some folks from South Carolina, Illinois,
Columbus,
it seems
Missouri.
like there's an interesting distribution of places where we see repeat outreach. San Diego, love San Diego.
Yeah.
Columbia, Missouri. All right, I was just passing through there this summer in my parents' RV, which these guys know well. Trying to center myself on the camera here.
We'll get started, and we'll see some folks joining. But first of all, I want to thank everyone for joining. Taking time out of kind of your busy week, and kind of as always, this is really for folks. Today we're really focused on deferred sales trusts, really focusing on kind of capital gains tax deferral. So kind of the key thing to this is really for folks who you have some type of appreciated asset that you're looking to sell, and you probably don't need the liquidity all up front. So this is probably not a great fit if you're planning to buy a home with kind of the proceeds of sale, but you're looking to really defer taxes when selling this appreciated asset and use that tax roll to kind of maximize what you get out of it. So today we're really going to be diving into deferred sales trusts, and just kind of as a kind of quick overview on Valur. So Valur, the idea of Valur, and I founded Valur, is to really just make it easy for people to understand what are tax mitigation techniques for whether it's ordinary income, capital gains, estate taxes, make it more transparent and easy to understand the benefits and trade-offs. And then we build technology to make it kind of seamless and accessible for folks to set up and manage these structures, so that it's not just accessible to kind of the 0.1%. And as part of that, we do a lot of education. So we have bi-weekly webinars. We're going to shortly start doing these weekly. So would love if you have feedback or topics you want us to talk about, please let us know. Jeff, want to give a quick overview on your background?
Yeah, of course. So I'm Jeff, as you can see on the screen here. I'm part of the founding team. I joined Monty right as Valur was getting up and running. Been here for a bunch of years now. My day job is that I run product and strategy development here, which means that I'm on the ground thinking with our team about which strategies we should be exploring and which ones are going to be the most useful to folks like you. I also always like to mention, just for context, as I'm talking through these things, that I'm a lawyer by training, and a lot of our team are lawyers and accountants, and we're really trying to come at this with a kind of a technical understanding, but as Monty said, in a way that's educational and helpful, both to advisors. I know I see a lot of advisors in the chat, and then also the end users. And also, just quickly, one plug before we get into the substance. Monty mentioned that we're doing these webinars bi-weekly now. We'll move to weekly, and always you can find additional video content, including replays of these webinars, as well as chopped up bits and helpful quick hits on our YouTube page. So definitely worth checking that out. We'll throw a link up to that in a little bit, so you can have a look.
Yeah, 100%. And before we kind of get into today's topic, the other piece to call out, a lot of what Jeff and the team builds is, so we have we have these webinars. We also have calculators and guided planner tools where it can help you understand what is the ROI of these different structures, as well as, or even taking a step back if you don't know where to get started, what are the different types of tax problems, what are different solutions for those, the trade-offs, and one of the kind of the exciting things that we'll be releasing soon. So you can actually compare the ROI of these different solutions in real time, compare the ROI, the liquidity, and to really understand some of the things we're talking about today. What are those quantitative as well as qualitative trade-offs kind of on your own? And then in addition, if you have questions, you can always set up time to chat with us for free. But to kind of getting into to kind of really what we're talking about today is, what are deferred sales trusts? They're also known as DSTs. It's a tax mitigation vehicle. We're really going to kind of walk through an overview of what they are, what are some of their benefits and trade-offs, some of the key scenarios where it does make sense, as well as some of the alternative solutions, how they compare at a high level, as well as on a quantitative basis in 2 specific case studies. And then we'll kind of leave some time at the end for Q&A. As always, please let us know in the comments if you have any questions about what we're talking about, or more broadly. We'll either address it in real time if it makes sense, or save it for later in our presentation where it fits better, or at the end. But always love to see questions. We want to make this as useful as possible for everybody. Going from there, we'll start with kind of what is a deferred sales trust. So really, a deferred sales trust has a couple of moving pieces. There tends to be really 3 parties involved. So take the scenario where I have a business that I'm selling. Jeff is the buyer. If I sold the business today to Jeff directly, I would pay taxes on that entire sale. The idea of a deferred sales trust is, instead of directly selling it to Jeff, I'll work with a third party. They will create a trust, typically called a deferred sales trust or DST. I'll sell my business to the trust on an installment note. So what that means is, typically these are 10-year loans. So instead of selling it to Jeff for $1 million directly, I'll sell it to this third party trust for $1 million plus 5% interest. So it pays that out each year for 10 years back to me. The key part about this is I only pay taxes as I get those installment note annual payments from the trust. So instead of paying all the taxes up front, I'm paying this spread out over 10 years on that side. Now you're potentially wondering, okay, what does a trust do with this business that after it buys it for the note? The trust then typically sells it directly to Jeff for that same price. So it's selling it to Jeff for that $1 million, but because the trust's cost basis is $1 million and it's selling it for $1 million, there's no tax liability there. And really what's happening is, in the interim, the trust gets to reinvest that money and essentially the idea is create more wealth with tax deferral. And this really goes to the core idea of this is, when you're selling appreciated assets, typically this is used for selling a business or real estate for illiquid assets. The idea is to sell it kind of in this multi-step way to defer taxes. And it ideally works best if you want that liquidity over a short period of time, less than 10 years, and have a conservative investment approach. So we tend to see this a lot for folks who are older. And we'll explain why those kind of constraints or best practice use cases really come into play. And just to kind of, and this is to kind of lay this out more, tactically, is I sell the asset to the trust in exchange for this note. The trust sells it to Jeff. And then because there's no taxes on that immediate sale, the trust is reinvesting that money. And then as that, over time, I'm getting paid back more. And the idea is I'm just deferring the taxes and getting interest on that.
And one important thing here, Monty, to draw out, which I think is the least transparent part of these things, or the least intuitive part of DSTs, which is what are the returns? What happens with the money while it's sitting inside of the trust? And what does
Yeah.
that mean for the seller, for you when you're selling your
Yeah.
business?
Yeah, it's a really great question. So one of the key things to call out is you or your family are not the grantor or the person who sets up this deferred sales trust, nor are you the beneficiary. You're simply a creditor. This deferred sales trust is set up by a third party, and there's a third party beneficiary. It's part of how they make this work. Um, and so what's happening is you are a creditor of the trust. The trust is buying an asset from you and paying it. You're getting paid back via kind of a loan that's spread out over typically 10 years, but can be different time frames. And so one of the important pieces of this is, if you understand kind of debt or loans, is you don't actually have upside on the trust investments, but you do have downside. When you sell that your business or real estate to the trust and it sells it to the third party, let's say Jeff, to keep this example going, the trust can then reinvest that money. Now, let's say that your installment note to the trust is at a 5% interest rate, and let's say the trust reinvests that money in the S&P and it's growing 10% a year. Because you're not the beneficiary of the trust, you don't get the upside of that growth. So even though the trust is paying you back that principal plus 5%, and there is that spread of 5% between the debt interest rate and the what it's earning, you don't actually get that. That goes to a separate, typically kind of the people who set this up who are getting that upside from the deferred sales trust.
And there's a question that I want to just preview and answer to, and also I want to draw that out just a little bit. Maybe a more positive spin on this is that as long as the investments inside the trust, which are being made by the trustee, typically with informal guidance from the seller, there's some question about whether the seller gets to have input, but you're not going to be deciding what the thing invests in. But as long as the investments in the trust match that interest rate that you have been promised on that loan, you're going to get that money. But as Mani said, you're not going to get more. You're not going to get less as long as it meets that rate, but you're not getting the upside. So if the investments in the trust return 7% per year, that's great because you're getting your 5% interest, but you're not getting the additional 2. That's staying in the trust, and at the end will go to typically the firm that you're working with to set this up. Which actually leads me to an important thing that I just want a meta point that I want to preview here to answer David's question about how this differs from what the IRS is discussing when it discusses monetized installment sales in the Dirty Dozen. One thing is, yes, this does share a lot of features of installment sales, including ones that the IRS has called into question. And as a result, importantly, this is not something, I think the tenor of this is important. This is not something that Valur offers in-house. We are happy to discuss it. We have calculators and the tools necessary for you to explore it. You'll see in the case studies that we think there might be, if you can get past that legal question, there might be a narrow case where a DST makes sense. But this is certainly not something that we are promoting over and above anything else.
And just to get into, we're clearly kind of shifting into kind of, hey, like this. So this one it's an installment sale. And let's just get into kind of the benefits and trade-offs because, I think that's kind of the heart of the questions. So the core benefit of this is tax deferral. First of all, somewhat kind of straightforward, but worth hitting on this point. Paying taxes later and being able to reinvest the money now is better. That's the core principle of this. There's also another piece of this. This is typically a kind of a small part of the upside, but there's some tax smoothing of, unless your kind of this income would anyways be at your top marginal tax rate, you can get some benefits of, if this is a large part of your net worth, is selling this can potentially drop some of your income into a lower marginal tax bracket by realizing the income over a decade or longer, can lower your kind of effective tax rate. You can get some savings there. But really the core benefit is tax deferral. Now, let's get into this. I'll just bring this David's kind of piece here of There is some legal gray area. And there is the IRS has been focusing on installment sales. And this is an installment sale, and there's a legal gray area, as we kind of call out here. It's been under increased IRS scrutiny in recent years. Now, the reason we say that there's some gray area is the broad idea of installment sales is even though there's multiple steps in this transaction, if the IRS views them as being tied together, they can essentially disregard it because there's no substance to this, and so you lose the benefit. Now, that being said, is a number, and again, we don't offer these, but a number of these, there's really one company that has, IP and trademarked the structure that really does this, and they work kind of through their own distributors. They have had success in audits on these. Now, again, that's kind of looking backwards. They've been able to hold up, and they have a pretty good track record. But this is an area that the IRS has taken particular focus on, and so there always is kind of risk in this, but there's particularly higher risk because installment notes and these kind of multi-step transactions that could be disregarded, the IRS has been taking focus on. That's so right. That is a real kind of
it's an important question, and I do think it's worth, for the folks who are new in the chat here, I see a lot of familiar names, but if you're just coming to Valur, I think it's worth explaining and exploring our approach to discussing and offering these strategies. As I said in the comments here, we do think it's important to discuss almost everything under the sun for one simple reason, which is that we get questions all the time from folks who are considering these things. And we'd rather put them in front of you, explain the pros and cons, and as here, really highlight that gray area or that challenge. And there are some things where we'll tell you it's not even a gray area. The IRS has said no. But if people are coming in asking and considering pursuing these strategies, maybe instead of something that Valur does offer, we think it's critical to discuss these openly and to talk about when they're a fit and when they're not.
Yeah, and I think this is just more broadly is tax mitigation, estate mitigation has historically been a very, I started Valur based on a personal experience going through this. It's a very opaque space where it's hard to get information on this. And so kind of our broad thesis is, how do we bring more transparency to this space of, just talking about what are the solutions and the benefits, the risks, the trade-offs. And this is where candidly, there is some risk here. The only reason we call it a gray area versus specifically is because the company behind this has had success in audits. And this is where it's, David calling out, there is a lot of bias towards that this is just a step transaction. They have had success in court cases, but that being said, IRS is really focused on this. But let's kind of get past, there is some gray area and step transactions. And the other kind of big downside of these is, one, there's kind of a pseudo monopoly of really one company does this. And as a result, there's fairly high costs. Typically, you're looking at costs of upfront, that is roughly 2% of the transaction, and then roughly 1.5% on an annual basis, which takes away a lot of the upside. Now, so speaking of kind of the upside, kind of getting to the third big trade-off, this is what Jeff is kind of referring to earlier, is there's different ways to talk about this, but we call it misaligned incentives, as because you have debt on this, you don't actually share any of the upside. So if if you're getting this installment note at 5%, you're getting your principal plus at 5% interest rate. If the trust invests that money and gets 10%, you don't get the upside on that. Now, on the other hand, let's say the trust invests that money and loses it all. Like all debt, you carry that downside. And so there is a tricky, misaligned incentives where they get the upside, but you carry the downside. And really here, the argument that the kind of company behind this would say is kind of their brand reputation ensures that they're not trying to bet this all on black in Vegas. So, but it is not fully aligned, and you do lose the upside. And in particular, we mentioned kind of upfront, one of the core use cases for this is if you want some tax deferral, but over a shortened time period. And a lot of this goes to, because you don't get the upside on the tax deferral of investments, you, the longer, and because of compounding, the longer that, if you're getting a 5% interest rate and, the S&P historically has returned 10%, if you're missing that delta, the longer, even if you defer taxes up front, if your assets are growing at a much smaller growth rate, over, more than a decade, you've really lost any upside there. And so that's kind of where this is really a short-term solution if you're comfortable kind of with that legal gray area as well. But to kind of, let us know if there's any questions on that. But otherwise, we'll kind of transition to.
My fault, Money. I clicked on the arrow. But I think the next slide is actually a helpful transition to addressing some of these questions. You previewed the idea that we view DSTs, even if you get past the Section 453 issue that David raised and the IRS questions, even then, DSTs are valuable and positive ROI as compared to alternative tax mitigation strategies in some narrow circumstances. And so I want to take maybe 10 minutes here to talk about what are the alternatives, and then we'll do a quantitative comparison. And what you all will see from this comparison is that, again, abstracting away the legal questions and just looking at the quantitative, a DST might outperform on a short time horizon for a narrow set of people and circumstances. But there are other higher ROI and certainly more legally sound approaches that Valur tends to focus on. And so as you see here, the three that we like to highlight and the ones that most people are comparing are a deferred sales trust, which Mani has already described, and we won't go really any deeper there. A charitable remainder trust, and I'll explain what that is briefly, and then an opportunity zone or a qualified opportunity zone, which is another kind of tax advantaged program. So quickly, before we get to the numbers, what is a CRUT, or a charitable remainder unit trust? A CRUT is another kind of trust, much less scrutinized and less questioned by the IRS, that is a way to defer the tax on a capital gain. The way a CRUT works is that you gift an asset, let's say the business that Mani was selling to me. He puts the business inside the CRUT before he sells it. The CRUT itself is a taxpayer, but it's tax exempt. And the reason it's tax exempt is that there's a charitable component. And unlike DSTs, where it's kind of a clever reading, or maybe some might view it as a not so clever reading of Section 453 and the installment sale rules, a CRUT is a specific creature of federal law. The regulations are written down. And what they say is, if you give an asset to a CRUT and the CRUT sells the asset, the CRUT pays no tax when it sells. In that way, it's a lot like an unlimited IRA or 401k, where you're deferring the tax on the sale of an asset by moving it into this vehicle and then selling it. You then get distributions from the trust over time, and that money is taxed. Typically, it's taxed. It has the same character as it had inside the trust. So if you sell long-term capital gains, it's nuanced, but typically the money will come out and be taxed as long-term gains. And then importantly, after many years, you're taking out distributions at the very end of the trust, which could be 20 years. It could be your lifetime, or your and your spouse's lifetime, or even longer. Whatever's left in the trust at the end will go to a charity that you've chosen. And that's why Congress and the IRS are very happy to give you this tax exemption, because you're promising a portion of this money to charity at the end. Now, we'll show you on the next slides that even giving away that portion to charity, a CRUT is going to be very high ROI on average, given certain assumptions. We think a CRUT is a really powerful and valid way to pursue tax deferral on capital gains, and it's a lot of what we do at Valur, and we'll show you the numbers.
Yeah, and just to add on to that, it is something that's statutory. It is in the IRS code, so there's not really any gray area as to kind of its validity, how it works, and kind of from like a validation. For instance, Phil Knight, the founder of Nike, this is how he sells a big portion of his Nike shares. And it's, again, this core principle of tax deferral of sell the assets now, you get to reinvest them and grow them pre-tax, and defer the taxes until you pull the money out. And with compounding, that can create a lot of value over the length of your time.
And this isn't supposed to be a charitable remainder trust webinar, so we'll move on. But the fact that I like to mention, and that seems to resonate with people, just in terms of peace of mind with CRUTs, since we had this question on DSTs, is that charitable remainder trusts have been around for literally over 1,000 years. They were created in England in the 1200s as a way for people to leave their property to the church during the Crusades. These things are just, they're around, they're statutory, they're well established. And so if you or your clients are looking for something that is not in a gray area, that might be something to look at and to pursue. And we'll talk about the numbers.
Yeah.
The last thing in this kind of group of capital gain oriented strategies that we want to mention is the opportunity zone. Opportunity zones are another creature of statute. They're a result of the 2017 Tax Cut and Jobs Act. An opportunity zone is a qualified opportunity zone fund is a fund that invests in real estate. It invests in real estate in specific identified geographical zones around the country that have been chosen by Congress for a reason. They're typically disadvantaged areas where Congress is trying to incentivize investment in real estate. And if you invest in an opportunity zone fund, you get to defer the capital gains tax on the amount that you put in the fund. So if you sold your business for $1 million and you put that $1 million into an opportunity zone fund, then you get to put off paying tax on that $1 million gain for a certain amount of time. One reason that opportunity zones are falling out of favor currently is simply timing. The program is set to sunset at the end of 2026, which means that even if you pursue an opportunity zone, you're only deferring that capital gain for a couple of years at this point, which is nice, but in terms of ROI, as you'll see on the next slides, not nearly as valuable as some of these other strategies. There are some additional benefits here. If you leave your money in the opportunity zone for 10 years, you get to pay zero capital gains tax on the growth in the fund, which can be quite valuable. But the main purpose, the deferral of the gain on your initial sale of a business or stock or crypto or whatever it is starting to be less and less valuable as time goes on. With that said, if you're interested in moving into real estate and being concentrated in real estate, and if you believe that the Opportunity Zone Fund is going to perform quite well, we have here that it's a top quartile fund, then it can theoretically still make sense. So we definitely like to mention them here as well. Monty, you're on. I don't know if you're talking. You're on mute.
Sorry about that. Just for historical context, opportunity zones and opportunity zone funds were created in 2017. And to kind of what Jeff was saying is created for 10 years. And so this is where in those early years, it's the same kind of set date of your taxes are deferred if you roll it into these funds within 180 days of your realization. Your taxes are deferred till the 2026 tax payment. So, April 2027. So in 2017, you're getting a decade of that, which was pretty valuable. Nice. As we're now 7 years in, you've only got 3 years of tax deferral. It's less valuable.
Rob, you asked what's the likelihood of extending the deadline. It's an important question with really any of these strategies, right? We talk a lot about estate tax, where there's a question as to what the lifetime giving limit is going to be after 2026. Opportunity zones are another one where what is Congress going to do is an important question. The answer is we don't know. This has not been at the center of the various tax debates over the last 6 months to a year. It's not a centerpiece of the campaign. And so it's actually really hard to say whether this is something that is likely to be extended depending on what happens.
Just to finish off the previous point, the balance of value from an opportunity zone has shifted from really tax deferral till, deferring your taxes on the realization, your previous realization till 2027 to, because now that's deferring it for 3 years, to the core benefit now is really when you reinvest that money into the opportunity zone, you don't have to pay taxes if you hold that for a decade. And so really, it's really shifted to kind of a concentrated real estate bet. And if that does really well, you get a lot of upside from that. And that's kind of really where that's come from. The other, by the way, one unique thing to call out that's different between opportunity zones and these other two strategies is with a deferred sales trust or charitable remainder trust, you have to move the asset into those vehicles before you sell them to get the benefits, the tax deferral benefits. An opportunity zone is fairly unique. You could sell the asset today and then tomorrow roll the proceeds from the sale into an opportunity zone fund. It is really unique, and you can kind of defer these capital gains taxes after the fact. And so that's a very unique aspect of it.
That's right. All of these different features roll into this next slide, which is our first of 2 case studies. I'm going to preview. This is the case study that demonstrates the narrow case, the narrow situation circumstances where a DST, again, purely mathematically, could make sense. We'll explain why. But just to set the stage here, what we're showing here is a case study along the lines of what we've been describing here. A California family selling a business for $1.4 million. They started it as a family business, so their cost basis is 0. And an important feature here is that we're assuming that because they are planning to take all of the proceeds out in the next decade because they need the cash, we assume that they're investing relatively conservatively. And so they're getting 6% annual investment growth, both in a DST, in a CRUT, and outside of these structures. Now, as we said, they're not going to benefit from the growth in a DST. That's going to go to the company that does it. But across the board here, we want to be apples to apples. And so we're comparing what if the investments are more conservative and show 6% annual growth, as opposed to the next example we'll show is assuming a kind of more traditional historical higher growth rate.
Yeah. And so that's kind of the assumption. The other piece is they're using all these proceeds in the next decade. So kind of their assumption is on this sale, they're not really planning to, they plan to spend it all in this next decade. So that's a big piece of this, is they're taking this out roughly an even split over the next decade.
And a big part of the discussion here is across these structures. And even if we're just talking specifically about an opportunity zone or specifically about a CRUT, even separate from the DST conversation, a lot of what drives the results here is, what is your plan? Are you looking for long-term tax deferral and therefore compounding? Yeah. Or is it this more kind of like upfront, I need the money to spend? And that drives a lot of the results from these studies.
Yeah, it's 100% the right call. A big part of this is time horizon and investment strategy, right? Like if you want a very conservative investment strategy, the DST doesn't give that, you don't lose much upside. Yeah. But to kind of get to kind of what happens in this, you're conservatively growing your assets 6% a year. You're spending it all in the next decade. In this scenario, the DST does come out ahead. Now, and this is where you really see the kind of mechanics of each of these structures play out, where the DST has the highest post-tax value, and the kind of numbers on the right are post-tax. Then it's CRUT, and then it's, CRUT's fairly close to not using any structure. An opportunity zone comes out in last, and kind of like the opportunity zone comes out in last because if you're spending all this money in the next decade, you're not holding your investment for the full decade, so you have to pay taxes on the opportunity zone, and you're losing what is today the core benefit of that.
And again, just to drive the conclusion home here, the DST stands out really only if you're planning on kind of foregoing the main benefits of the other strategies. A CRUT and an opportunity zone really shine, and especially a CRUT shines if you're letting the money ride and growing it, compounding tax-free for at least the medium term, 20 years or longer. Yeah. If you're looking for a quick hit, you're not going to get the benefit. You're deferring tax for a few years in a CRUT or an opportunity zone just isn't that valuable. And that's why you see the DST come out ahead here. With that said, most of our clients, and I think most of the clients of the advisors on the call and folks that we talk to, are playing the long game and are looking more for a kind of a longer term strategy to maximize their family's wealth. And that might not be where the DST shines quite so much.
Yeah. And just to kind of if you just change the scenario a little bit, let's say for this same scenario, even if you didn't have a long time horizon, you plan to spend all this money over the next decade, if you just invest that money and assume a 10% growth rate, actually in that scenario, the DST doesn't really come out ahead of the CRUT or not doing any structure in reality. And that really comes down to the fact of you're losing that upside. In this scenario, the DST is getting your principal plus a 5% interest back over the decade. And so it's really only losing 1% of investment upside. that doesn't benefit the beneficiary. But if you have 10% growth per year, then all of a sudden each year it's losing 5%. And even this is where it's paying the taxes up front, but then being able to grow at 10% and carry that upside actually comes out roughly even. And the second, kind of going to the kind of this next case study, is if you take this over a longer time horizon, so take that 10% investment growth, and instead this family is planning to use the proceeds over the course of their life. So let's say roughly 40 years. They're getting, let's say, take this scenario a little bit further. If they're getting bought and they're going to stay on as part of the business for the first couple of years, get paid a salary. And then starting in year 4, they start to take distributions. What you actually see is the charitable remainder trust comes out the furthest ahead. And it really comes out to the kind of the fact of, one, in the charitable remainder trust relative to deferred sales trust, you get that investment upside. So you're getting the benefit of that 10% growth and being able to take those distributions. And that's kind of really, second you start to go to a longer time frame or higher investment growth, the DST really lose any of its tax benefits. And by the way, that's ignoring kind of that legal gray area. That is something you'd have to be comfortable with to really move forward with that. The opportunity zone, you may be wondering, why doesn't that really come out ahead here? An opportunity zone really makes sense if you don't need money for the next decade. The reason behind that is, again, just where we are in that timeline of most of the benefits are if you don't need money for the next decade and your investment in the opportunity zone can grow and then be sold tax-free. So if you start taking out distributions in this next decade, you're really losing those benefits of an opportunity zone. And so that's kind of really why that doesn't come ahead of the other structures. And then, in this case, doing nothing, you're relatively coming out ahead because you get the 10% investment growth, and there's not the cost of an opportunity zone, which can have high fees. And unlike the DST, you get to the upside. And so it's kind of an interesting contrast of, there's a very limited scenario from a quantitative point of view where DST can make sense of short time horizon, conservative investment approach, plus qualitatively being okay with that legal gray area and risk. But then on the other side, once you shift towards a longer time horizon, it really loses quantitative appeal. And you start to look at other solutions of, do you want any of the money up front? Or do you not need the money for a decade or something like that, where an opportunity zone can come into play?
Sorry, Monty. We got a CRT specific question here from Noah, and we're kind of coming to the end here, so happy to maybe address that. And by the way, we've got 10 minutes left or so in our originally planned time. We're happy to stick around. If you have questions, feel free to put them in the chat, and we'll take them as we go. Noah, to answer your specific question, which is, can you structure a CRT with income for multiple generations? The answer is yes, subject to some limitations. It depends on a few things. Most importantly, the ages of the participants involved. In general, with a CRT, there are limitations on how long a trust can last. And if you're too young, then doing it for your lifetime and then for additional time for your kids or for your grandkids, the trust is just going to last longer than the IRS is comfortable with. And there's a formula for this. And so the rule of thumb here really is, if you are 30 or older, you can do a lifetime trust and add your kids on at the end for at least a few years, create an income for them after you pass away. If you'd like to do this with both parents and then add on a term for the kids afterwards where they get an income, typically the parents have to be kind of in their early 40s or older. This is not a linear formula, and we're happy to do the calculation for you. It really is case by case, but in principle, you definitely can involve the later generations in a correct.
And the rough kind of thing on kind of like from a math point of view is that the IRS really doesn't want the charitable trust from an actuarial standpoint being expected to last longer than 55 years. And so first of all, you may have great health, your family may have great health, so you may live for 70 years, but the IRS typically essentially looks at, based on how old you are, they round your age based on kind of your month to see, based on your age, how long is the average person your age going to live. And so then they use that. And so to Jeff's point of, If you're an individual, you have to be 27 or older or 26 and a half or older to do a lifetime. If you're married and you want to do you and your spouse, you typically have to be, both of you have to be close to roughly to 40 years old. But if you're doing a parent and a kid, you can actually do a combination of term and lifetime. So you could, for instance, do the parent's lifetime and then the shorter of the child's lifetime, or 20 years, to kind of make it fit within that.
That's right. And you know, we're happy to go into the weeds. As you can see, we've been studying this stuff for years now, and there's a wealth of knowledge on the team. Importantly, you have access to us. We put that schedule link up, and now we've moved on to this last slide. I'll take it down. But the idea here is that we're at your service, and especially for advisors who have these kinds of nuanced questions beforehand. Maybe you have a client in mind who might be able to use this, but you'd like to understand, you'd like to learn the nuances before you bring it to them. There are a couple of ways that you can get up to speed. The first thing that we always recommend is that you check out our knowledge library, which is at learn.valur.com. You should also spend time with our calculators. As Monty mentioned this, but we have a calculator for each of these strategies. And very shortly, within the next couple of weeks, we'll be rolling out a robust set of comparison calculators where you can look at what is the potential return, like we did on those slides, between a CRUT and an opportunity zone and doing nothing. So you should spend some time with those tools, but then always, if you're interested, come and sit down with us. Schedule a time. It's right there, valur.io/schedule. You can just put a time on our calendar and we'll sit with you and we'll go through the nuances, the nitty-gritty of these strategies, really in as much depth as you need to get you comfortable with bringing this to your clients. And we find that's really valuable. There's a bunch of advisors, as you can see in the chat here. I guess you can't tell that they're advisors, but we see a bunch of advisors in the chat who have taken the time to spend with us and learn these strategies, and they're bringing them to their clients, and they're succeeding and adding value for their clients and picking up new clients as well. So don't hesitate to use us. That's what we're here for, especially again for the advisors, as well as if you're an end client, a client who might want to do this yourself. You don't have an advisor, we can help too.
Yeah, I think those are kind of like the key things. Yeah, feel free you can use our tools. There's no cost, content, videos, these calculators. You can also directly chat with us. Again, no cost. Our broad kind of mission is, how do we make it easier for people to understand this, bring transparency to the space, understand these structures? Candidly, the way that we make money, just to be transparent, is if you use these structures, we take care of all the administration, from kind of the setup to ongoing administration, tax filing, ongoing optimization. And that's all that we charge for. But otherwise, we're really here to help you understand and be able to better understand how you can utilize this to build wealth for yourself. We'll give it kind of another minute to see if anyone has questions, but feel free to ask anything kind of related to this or more broadly. And just as kind of an FYI, again, we're doing these webinars at least every other week, and we'll start doing them shortly every week. But our next one is in 2 weeks on the 25th, is on intentionally defective grantor trusts. This is the most popular estate planning trust structure. It's really geared towards folks who are over the estate limit and want to pass on assets to future generations and avoid pay estate taxes. It's a really unique structure that has some complexity, but we're excited to chat about that. And you can sign up on our website, or we'll also include that when we set with this video. We aren't sending I don't believe we're sending out a recording of this webinar, but we post on our YouTube page, which we can share the link for. It'll be there. I believe it'll be posted right after this ends. So.
Looks like, did we get one more? We have the question about recorded. We are sending a recording out. It looks like we just got word from the back office. So that'll come after this. And as Monty said, YouTube is a great resource. We put this we put these webinars up, as well as bite-sized looks at everything that we do. And then as long as we're kind of seeing if anyone has additional questions, I'm just going to put up one more link, which is to the calculators that we have for all of these strategies right here. If you go to app.valur.io, You will find everything that we do, including those calculators, guided planning tools. We'll do another webinar on this at some point, but the idea here is that you can give us a few details on you or your client's situation, answer some questions about your finances, and more importantly, your goals and what you're looking to do. And we'll give you a menu of options, a menu of things that you might consider pursuing, which might include opportunity zones. It might include CRUTs. If you're talking about estate tax, there's an entire different conversation to have there, which, by the way, we'll be talking about on the 25th. Or even ordinary income. We have a number of clients who come in and find via those tools that there are solutions that they didn't even know existed for things like their W-2 or their business income or their RSUs. So strongly encourage you all to check out the site, the knowledge library, and then, as we said, schedule a call, get in touch, spend half an hour with us, figure out if what we're doing is something that you can use, and we'd love to talk to you. So I guess unless there are any additional questions, only 1 minute late, we can call it.
Yeah. Thanks, everyone. Really appreciate taking the time to join us today.